Today, we are diving deep into the financial engine of, well, a massive data and analytics powerhouse. We're looking at their Q3 2025 results.
Mm,
And if you needed proof that proprietary data is still king, look no further.
yeah, the top line figures really tell a story.
They do. Revenue grew 9% for the quarter, and maybe even more importantly, diluted EPS. That grew a soaring 24% year over year.
Those aren't just big numbers. That kind of jump suggests, operational leverage and strategic efficiency are really kicking in hard.
Right.
So to understand how they actually did this, and maybe more importantly, how sustainable it is, we're going to dissect the Q3 2025 earnings call transcripts and the detailed 10Q filing.
Okay.
Our mission here is really to get the strategic why behind this acceleration, particularly how they're using AI and M&A and what the big structural changes like the mobility spinoff tell us about where this business is heading.
And what jumps out immediately? I mean, it's the fortress of recurring revenue that just holds the whole thing up. Look at the segment mix. Market intelligence, that's the research and data arm, it boasts 96.5% recurring revenue for the quarter. Just huge.
And commodity insights is right there too, 91.3%.
When your revenue is that sticky, that predictable, it gives you incredible resilience, to weather market cycles.
Exactly. And that stability, well, it allows for those aggressive strategic investments we'll talk about. Geographically, yeah, the U.S. capital markets are still the biggest piece, 61% of total revenue.
Mhm.
But this is truly a global platform. International markets bring in 39%. Europe's the biggest chunk of that at 23%. Asia at 11%. So it shows they're really tapping into global financial complexity to keep that growth engine running.
Okay, let's unpack market intelligence then, or MI. This segment saw Q3 revenue climb a healthy 6%.
Pretty good, yeah.
But the operating profit surged by 20%. Now, that's a huge gap between revenue and profit growth. Suggests serious operational leverage, right? What's driving that margin expansion?
Well, the growth seems to be coming from embedding themselves deeper and deeper into their clients' daily work. They specifically called out strength in data, analytics, and insights, enterprise solutions, and those premium credit and risk solutions like Ratings Express and Ratings Direct.
Right.
But the real secret sauce here, I think, is enterprise solutions. These are their really mission-critical workflow tools. Think WSO, iLevel, ClearPar, Debt Domain.
Yeah.
Stuff that private equity firms, asset managers, banks basically live inside of.
So it's not just data, it's the platform itself.
Exactly. It's the platform you have to use to do your job effectively.
Speaking of mission critical, this is where the strategic story gets really interesting. Management claimed, get this, almost 90% of market intelligence is considered AI defensible.
That's a big number.
It sounds like a powerful shield in the age of, ChatGPT and open source LLMs. But 90%, is that real or is that just smart PR? Are they saying Gen AI isn't a threat to that much of their business?
Well, it's a bold claim, definitely, and they justify it by breaking down their product lines into sort of layers of proprietary moats.
Okay, like what?
The first layer is their credit and risk solutions. These use proprietary data feeds and benchmark models, unique data they own, like their Ratings Express system. And AI can't train on data it can't legally or physically get access to.
Got it. So it's not replicable from the outside. What's the second layer?
The second is those enterprise solutions we just mentioned, WSO, iLevel, and so on.
The workflow tools.
Exactly. Because they're so deeply embedded, the software that manages the client's actual workflow, they create really high switching costs. You can't just easily rip out the software your whole private equity team uses to track deals just because some new AI chatbot offers, similar surface-level insights.
Okay, so it's not just the data, it's the workflow hook, the stickiness.
Precisely. And the third part is their data analytics and insights business. They estimate about half of this category relies on proprietary, curated, or enhanced data. Things like fixed income pricing or specialized maritime shipping data.
Stuff that needs cleaning and context.
Right. It's the human curation, the cleaning, the aggregation, that stops a simple LLM scrape from duplicating the actual value they provide.
That strong defensiveness, it's clearly fueling their expansion and M&A activity. We saw MI annual contract value, ACV, that's the forward-looking measure of subscription health, growing in a pretty solid 6.5% to 7.5% range.
Very healthy.
And they are putting serious CAC behind this strategy. Most notably, that pending $1.8 billion acquisition of With Intelligence.
That deal, which they expect to close late 2025 or maybe early 2026. It's a direct strategic move. It's about solidifying that MI moat by buying specialized, hard-to-get data.
Right.
With intelligence focuses on private markets intelligence, which is an area where data is super fragmented, very opaque.
Makes sense.
And they also made smaller targeted buys, too, like the Automatic Identification System, AIS data services business from ORBCOM that gives them more maritime and supply chain intelligence.
So this looks like a very self-aware strategy then. Use cash to buy unique data sets like private markets via with intelligence, then integrate them using foundational tech they bought earlier, like TerraHelix, which helps with data interoperability and building AI applications.
Yeah, it's about building the defensible inputs, the unique data, and then perfecting the output engine, the platform, and analytics.
Okay, let's pivot to the bedrock of their profitability. The really high-margin financial engines. Ratings, the credit rating business, saw Q3 revenue jump 12%.
Big jump.
And operating profit surged 21%. That's spectacular growth. But how much of that is driven by, let's say, temporary market conditions?
That's always the critical question with ratings, isn't it? The growth came from both the stable non-transaction revenue and the more cyclical transaction revenue.
Hi.
And the transaction side was the big driver this quarter, primarily corporate bond ratings and structured finance.
Why the surge there?
Well, we saw increases in issuance volumes, specifically in the very lucrative high-yield market. Borrowing spreads tightened, which made refinancing attractive for companies.
Ah, okay.
Plus, new issuance of collateralized loan obligations, CLOs, those complex packaged debt products that drove structured finance volumes way up.
So favorable market conditions for debt issuance definitely helped drive those fees. If borrowing spreads widen out again, how insulated are they? Is there a floor?
Well, that's where the non-transaction revenue piece comes in. That also increased, mostly due to surveillance revenue. Those are the fees they get just for monitoring outstanding debt that's already been rated.
Steady income stream.
Exactly. And continued expansion at their Crystal subsidiary. That's growing its wealth management footprint, partly through the pending acquisition of Price Metrics. So yeah, while transaction revenue can be volatile, the recurring surveillance and subsidiary revenue provide a stable foundation. It keeps margins high, even if issuance spikes come and go.
Okay, now let's talk indices. This feels like the ultimate data royalty collector business. Q3 revenue up 11%, operating profit up 12%.
Very consistent growth there.
And when we talk about indices, we're primarily talking of asset-linked fees, right? Fees based on the sheer volume of money tracking their benchmarks.
It's probably the purest form of recurring revenue they have.
Yeah.
And you really have to sit up and take notice when you look at the underlying stats here.
Go on.
Quarter-ending ETF assets under management, AUM, associated with their indices, reached an absolutely eye-watering $5.172 trillion.
Wow. Over $5 trillion tied to their benchmarks. Let's just pause on that number for a second. That's the definition of an oligopoly position, isn't it?
It really is. And that growth, it was driven by two key factors, both pretty significant. Price appreciation, strong equity markets, contributed $341 billion to that increase.
Okay, market helping out.
But critically, net inflows into the associated exchange-traded funds added another $96 billion just in that quarter.
So new money coming in, not just market uplift.
Exactly. It just underscores this undeniable long-term shift toward index tracking products in the global investment landscape. It cements the index business as a massive, stable value driver for them.
Okay, so this spectacular success in their core data and index businesses, it's clearly informing these major structural moves they're making. The biggest one is the mobility segment. That's on track for a full separation via a tax-free spinoff.
Yeah, announced back in April 25.
Right, expected to complete over the next 12 to 18 months. Why shed an asset like that when the core business is booming? Seems counterintuitive, maybe.
It's all about strategic focus. Mobility, it reported solid Q3 numbers itself, revenue up 8%, profit up 21%. So it's not like it's a disaster.
Right.
But internally, it's kind of divergent. The growth is heavily driven by the dealer and financial businesses, things like new business acquisition, strong underwriting performance.
Okay, but that manufacturing revenue piece is dragging it down, you mentioned.
Exactly. The decline in manufacturing revenue was a noticeable drag. They specifically cited broader market volatility, ongoing uncertainty around EV adoption, and tariff-related market conditions impacting that part.
So it doesn't really fit the core identity anymore?
It just doesn't. Mobility cyclicality, its exposure to auto manufacturing, it doesn't really mesh with being a proprietary financial data and index provider. So by spinning it off, they're simplifying the investment story for the main company and theoretically maximizing the value of the remaining data segments. make sense strategically.
Okay. Before we move to capital allocation, let's quickly touch on commodity insights. Q3 revenue up 6%, profit up 11%. Where did the momentum come from in the energy and resources space for them?
The momentum there came mainly from two areas: energy and resources data and insights, and price assessments.
How so?
Well, they're expanding product offerings to existing customers, often under enterprise use contracts, which means more usage for fixed fees, basically higher value per customer,
Got it.
and also higher sales usage-based royalties from licensing their data to commodity exchanges. When trading volumes go up on those exchanges, they benefit directly.
Makes sense. Any weak spots there?
Yeah, the one soft spot they mentioned was in upstream data and insights revenue. That saw a decline, apparently due to increased customer cancellations and maybe lower one-time transactional sales in that specific area.
Okay, the operating results were strong, clearly. But let's dive into the capital strategy because, wow, management was hyper-focused on shareholder returns and simplifying the portfolio this quarter.
Relentless is a good word for it. The commitment to returning capital is just constant. They increased the quarterly common stock dividend again to $0.96 per share.
Okay, standard playbook.
But the real aggressiveness is in the share repurchases, particularly through those accelerated share repurchase or ASR agreements.
Right. For you listening, maybe just quickly explain what an ASR is and why a company would use it.
Sure. An ASR is basically the fastest way for a company to buy back a large chunk of its stock off the market. It boosts earnings per share almost immediately because you reduce the share count quickly.
Got it. Faster impact than open market buys.
Exactly. And they used $2.5 billion of cash to purchase 4.3 million shares just in the first 9 months of 2025. That's a significant step up from the $2 billion they spent in the same period last year.
And they still have authorization for more.
Yeah, they mentioned 7.4 million shares remain available under their current repurchase program from 2022, so plenty of dry powder left.
And that leads directly to the source of some of that cash, right? The massive inflow they generated from the divestiture of the OST-TRA joint venture.
That's right. The sale of the 50/50 OST-TRA joint venture, that was a post-trade services asset they shared with CME Group. It was sold to KKR and completed on October 10th, 2025. So just after the quarter ended technically, but the impact is huge.
What were the numbers on that?
The total enterprise value is $3.1 billion. S&P Global got $1.5 billion in cash proceeds. After tax, they're expecting about $1.4 billion in net proceeds, and they anticipate booking a pre-tax gain of around $270 million from the sale.
So that sale essentially self-funds that big with intelligence acquisition we talked about. Pretty much, yeah. And it also contributes significantly to funding those accelerated share repurchases. It's a really nicely choreographed capital return and portfolio shaping strategy. Sell non-core, buy core, return the rest.
Very clear. Okay, finally, we should probably briefly touch on the regulatory environment notes in the filings. Anything major stand out?
Two brief but relevant points, I think. On the legal side, they reached a settlement agreement in Q3 for that long-running Australian class action lawsuit. It related to alleged investment losses in CDOs rated before the financial crisis. So basically clearing up a legacy issue.
Good to get that off the books.
Definitely. And on the tax front, they highlighted the importance of that June 2025 G7 agreement reached with the U.S. It's expected to exempt U.S. companies from the OECD Pillar 2 global minimum tax rules. That offers some crucial tax clarity for them going forward, which is always welcome for multinationals. Hashtag tag outro.
Okay, so wrapping this all up for you, the learner. The core story, the core thesis of this company, it seems crystal clear right now.
We see really strong financial performance, powered mainly by that data and index subscription revenue, which is highly recurring, very sticky.
The foundation.
Exactly. Then you've got aggressive strategic M&A focused purely on fortifying market intelligence. That's their whole AI defensiveness strategy we talked about, building those specialized data modes.
Right, doubling down on the core.
And critically, they're backing this strategic focus with just relentless capital return to shareholders, using divestitures like OST-TRA to effectively fund both acquisitions and buybacks. It's a very focused loop.
Yeah, and this aggressive shift towards simplification and core data excellence, that really is the dominant narrative coming out of these results.
Yeah.
Given the successful sale of OST-TRA and the pending spinoff of Mobility, the company is just doubling down, betting big on being a highly specialized insight provider.
Right.
And this raises, I think, an important final question for you to consider. Does this intense move toward segment simplification, shedding non-core assets like post-trade services and the cyclical auto segment, Does that maximize the future value proposition of these highly specialized data providers in a world that's increasingly dominated by, well, generalized generative AI?
Hmm, interesting question.
Is betting big on a narrow, deep moat the only way to really thrive when computational power and generalized knowledge are becoming essentially commoditized? It's a powerful, focused bet they're making. Insight over breadth, something to watch.